Hello, thank you for joining us today. My name is DarrenTomasini, and we're going to be talking about risk profiles and actually how important they are and relevant to everybody. So what is a risk profile? A risk profile is an assessment of an investor's willingness and ability to take risk when investing, and it plays a critical role in determining how an investment portfolio is structured, as different levels of risk are associated with different potential returns and volatility, which are linked to different asset classes. When an advisor completes a risk profile for a client, it helps ensure the portfolio decisions align with financial goals, time horizons, and emotional tolerance for market fluctuations. Now, risk profiles are generally categorized into several broad categories, ranging from a conservative investor all the way up to an aggressive investor. Now, it is important to note that there is no standardized definitions for each category and for what mix of defensive and growth investments fall into each category. And to be totally honest, if you ask me, I think there should be. Now, statistically speaking, the most common category that people fall into when they do a risk profile is known as a balanced investor. However, there can actually be a broad difference in definition from what one super fund can define a balanced portfolio to another balanced portfolio. The superannuation funds are actually advertising their fund's performance, and they'll be saying that our balanced option has outperformed these other funds over a certain period of time. Their main claim is that it's because of low fees. However, it's actually quite misleading because the other funds that they are comparing against are actually other funds that actually have a different risk profile in their comparison. And it's actually probably the risk profile itself that actually makes the biggest difference rather than the low fees. And if you have seen these types of funds, you probably know which funds I'm referring to. Now, to give you an approximate summary of what different risk profiles could actually look like, and keep in mind these vary a lot between different superannuation funds and even different financial planning firms. Each will have their own definitions as to what falls into which category. The conservative risk profile would prioritize capital preservation and stable returns over high growth. These conservative portfolios, investors usually have a high allocation to defensive investments such as cash and fixed interest investments, with a smaller exposure to growth investments like shares and property. These commonly are profiled by investors who have short time horizons, low tolerance to volatility, or a strong need for capital certainty. A moderate risk profile seeks a balance between income, capital stability, and growth. Moderate profiles generally include a mix of defensive and growth investments, aiming to smooth returns while still providing long-term capital growth. Investors with medium-term goals or with approaching retirement often fall into this category, as it allows for growth while maintaining downside risk. However, it is not uncommon for investors already in retirement to have this type of portfolio. A balanced risk profile sits between moderate and growth-focused strategies. Now, this profile is suitable for investors with longer investment horizons who can tolerate some market volatility but still value diversification and risk control. And statistically speaking, this is the most common risk profile investors fall into, and is why most super funds have it as its default option. Now, as mentioned before, the most common profile that people quite often fall into is known as the balanced risk profile. Now, when I first entered the industry back in 2010, the company I worked for had a risk profile for a balanced investor as having 50% defensive investments to 50% growth investments. Now, over time, I have seen a gradual shift in the industry where a balanced option typically across different financial planning firms and superannuation funds has shifted more up to have more growth investments. Quite commonly around about a 60-40 split between growth and defensive, or a 70-30 growth to defensive investment split, which is generally where most of the market really sits around. However, some funds I was mentioning just before, or was highlighting before, actually have up to as much as 80% into growth investments and 20% into defense investments. Growth and high growth risk profiles are designed for investors seeking a higher long-term returns who are comfortable with significant short-term volatility. These portfolios have a higher allocation of growth assets such as Australian and international shares and property, with limited exposure to defensive investments. Now, growth to high growth investors typically are those of a younger generation, those still in accumulation phase who have many years of work perhaps ahead of them. However, I have seen it before where even those in retirement actually still have a high growth profile, because one of their key focuses is maintaining purchasing power of the superannuation benefit, so hopefully that will actually last longer than expected. An aggressive risk profile represents the highest level of risk tolerance, often focusing almost entirely on growth assets or concentrated investments. While the potential for higher returns is greater, so is the risk of substantial loss, particularly during market downturns. Now, an aggressive portfolio has the potential for much greater returns, and the statistics can certainly back that up. However, it does come with an exposure to more volatility and a lot more risk involved, and you need to have the tolerance for that. Now, an aggressive risk profile is not as common. You can generally find them around maybe 5 to 10% of the population from some statistics. However, people do need to realise that property is actually a growth investment, and for those investors out there who do have large investment property portfolios, can actually fall into this type of category. However, from their point of view, thinking of property is really safe investment to have, in their mind they can actually think it's actually defensive, when in fact it's actually not. Now, as mentioned before, it is important to note that every superannuation fund and financial planning firm will have their own definitions as to what risk profiles suit which categories and which mix of defensive and growth investments will fall into each category. Now, it is always up to the individual as to how they feel about the outcome of their risk profile. So quite often it comes down to them actually having an understanding of the differences between each of the categories, and it's up to them to make their own personal choice at the end of the day. Now, when considering different types of risk profiles, one way of looking at it is actually looking at the historical performance of different types of categories and what they can actually look like over a long period of time. An interesting piece of research I'd like to show you is one from Bloomberg and Van Eck, which demonstrates the difference in portfolios over a 20-year and a 41-year cycle. Now, this is actually quite useful because it gives you two different sets of data points, but you can also see the correlation that happens in amongst all the different types of portfolios and the performance over a long period of time, and you can see where the differences can actually lie. So please do pause the video and have a good look for yourself. Now, you're probably wondering, Darren, which one of these definitions do I fall into and how can I find out? Well, one way you can do that is contacting a financial advisor. Now, with every financial advisor, there's always a standard procedure that we do, which is asking a risk profile questionnaire. A risk profile questionnaire is essentially a type of psychometric questionnaire which helps us ascertain as to what potential one of these categories you might actually fall into. Now, please note, as always, this is general information only and does not take into consideration your personal circumstances. So if you'd like personal advice, I recommend you go see a financial planner. By all means, give us a call. But when it comes to risk profiles, it is important that you seek a risk profile questionnaire through an advisor, and that way you can get a better idea as to what your true risk profile is, and also have a good conversation with them about the different types of investments in your portfolio. Scan the QR code if you want to give us a call, and don't forget to like and subscribe.